massive high-interest loan to build a 10-lane superhighway.
Right, just right out in the middle of the desert.
Exactly. And you were doing it because you're absolutely convinced that, a massive futuristic city is going to be built there in 5 years.
But until that city actually arrives, the maintenance costs of this totally empty highway are just bleeding you dry.
Yeah, and that is exactly the multi-billion-dollar dilemma that the world's biggest tech companies woke up to this morning. Welcome to our daily market deep dive.
Today is Friday, July 24, 2026. And, if you just glanced at your portfolio today and saw the S&P 500 hovering at a virtually flat close of 7,411.98.
You'd probably assume we just coasted through a sleepy summer Friday.
Yeah, you would. But beneath that flat line, the market was digesting just absolute chaos.
We are talking about massive intraday swings in crude oil, a sweeping new barrage of U.S. tariffs, and a geopolitical chess match in the Gulf that is, frankly, keeping energy traders awake at night.
So in today's deep dive, we are exploring the fundamental logic behind these wild swings. We'll look at why tech stocks are wobbling under the immense weight of their own artificial intelligence capex, and how trade wars are pouring fuel on an inflation shock.
But before we get into all the mechanisms driving this, a quick reminder to you listening. This deep dive is strictly for market context and discussion.
Right. We are just here to help you understand the baseline environment.
Exactly. This is not personal investment advice or an investment recommendation.
So should we jump in?
Let's do it. So, session 1. What set the stage before the U.S. session?
To really grasp why the U.S. Open was so incredibly tense today, we have to rewind slightly. We need to look at the massive carryover narratives from Thursday.
Right, because the entire macro baseline was set by two pretty heavy anchors.
Yeah. First, you had Alphabet dropping its Q2 earnings, but the headline wasn't just the revenue. It was their staggering capital expenditure guidance. I mean, they're projecting $195 billion to $205 billion for the year.
That number is just historic. And it fundamentally alters how investors view mega-cap tech, right? Because for years, these companies have been cash-printing machines.
Exactly. But Alphabet just confirmed that the AI infrastructure race is severely accelerating. That means hundreds of billions of dollars are being diverted away from free cash flow.
Which is the actual money left over that enriches shareholders.
Right. Instead of going to shareholders, it's being poured directly into physical data centers, servers, and, energy grids.
Which perfectly sets up the second anchor from Thursday.
Yeah.
Which is the European Central Bank holding its benchmark rate steady at 2.4%.
Yeah. So you have tech companies demanding infinite capital to build the future, but the central banks are just flat out refusing to make that capital any cheaper.
It creates a brutal squeeze. I mean, the ECB is looking at the inflationary impacts of these global energy shocks, and they are essentially telling the market that central banks are not riding to the rescue with rate cuts anytime soon.
Right. The cost of capital is staying high, right as the capital requirements for mega-cap tech are going even higher.
And we really saw the real-world impact of that high-rate environment in the overnight data. As we moved into Friday morning, the July S&P Global Flash PMIs hit the wire.
And for anyone unfamiliar, a Flash PMI is basically a real-time thermometer of business activity. Anything above 50 means the economy is expanding.
And anything below 50 means it's shrinking.
Right. And the divergence we saw overnight is honestly one of the most important macro signals of the week.
Yeah, the U.S. economy remains surprisingly resilient. The U.S. composite PMI actually jumped to 53.6, which soundly beat forecasts.
U.S. services and manufacturing are both just humming along. But across the Atlantic, the European economic engine is really stalling out.
Both the French and German services sectors officially printed below that critical 50 level, so they are contracting.
Yeah.
So what does this divergence mean for your portfolio? Because when I see the U.S. booming while Europe stumbles, my first instinct is that global portfolios just need to heavily overweight U.S. domestic equities and just avoid Europe entirely.
Well, the ECB is totally trapped here. This is the textbook definition of central bank demand destruction against supply inflation.
Because normally, if your economy is shrinking, you just cut interest rates to stimulate growth. Right.
Right, but they can't. Overnight, we had ECB officials making incredibly hawkish comments. Sinkus basically warned that if oil hits $100 a barrel, it will immediately resuscitate global inflation.
Oh.
Yeah, the ECB cannot cut rates to save European growth because the energy supply shock is keeping price pressures just dangerously high.
And, while all this macroeconomic tension was building in Europe, there was this quieter but incredibly critical development brewing in the semiconductor space.
Oh, right, in China.
Yeah. Early Friday morning, reports surfaced that Chinese memory chip leaders, specifically CXMT and YMTC, are pushing massive capacity expansions.
We can't ignore that story because memory chips are essentially the foundational bricks of the AI era.
Right, CXMT is apparently planning to more than double its monthly wafer output. You just can't run these massive computational models without an ocean of memory.
Which puts U.S. policymakers in a really tricky spot.
It does. On one hand, the U.S. administration is reportedly split on whether to impose new export limits on these Chinese firms. But then you have companies like Apple desperately seeking assurances that CXMT won't be blocked.
Because they need those chips to keep their own supply chains affordable. It adds a fierce layer of competitive pressure to U.S. chipmakers right when they are most vulnerable amid ongoing U.S. export scrutiny.
Exactly. So that briefly summarizes it. We had resilient U.S. data and hawkish European central bankers creating a really tense setup for Friday's open. Let's take a short break and then dive into the U.S. trading session.
Well, Session 2. What moved markets during U.S. trading hours?
Well, when the clock struck midnight Eastern time, that theoretical inflation fear we just talked about became extremely real.
Because that was the moment the Trump administration's sweeping Section 301 forced labor tariffs officially went into effect.
Right. And to give some quick context, Section 301 is a U.S. trade law that allows the president to unilaterally impose tariffs if a foreign country's trade practices are deemed unfair. In this case, forced labor practices.
We are looking at levies ranging from 10% to 12.5% across multiple nations, and that includes a brand new 10% tariff slapped on India.
It is a really aggressive escalation of protectionist policy. But what is truly fascinating to me is what they chose not to tax.
Yes, the strategic exemption list, it is highly calculated.
They explicitly exempted high-volume commodities like oil, gas, fertilizer, and agricultural foodstuffs. They want to pressure international supply chains over forced labor, but they know that if they tax fertilizer and fuel, the price of groceries and gas in the U.S. just skyrockets tomorrow.
They are desperately trying to wage a trade war without triggering a catastrophic consumer inflation shock at home.
And that trade war is expanding on multiple fronts. By Friday afternoon, Trump issued a direct threat to impose broad tariffs on the European Union, specifically in direct retaliation for Thursday's €890 million Digital Markets Act fine against Google.
It's wild. The U.S. government is essentially using sovereign trade policy as a shield for U.S. tech monopolies.
Right. If the EU decides to penalize an American megacap company for anti-competitive behavior, the U.S. is threatening to tax European exports in response. Multinational corporations are caught in this transatlantic crossfire.
That threat alone forces markets to completely reprice regulatory risk. But while the trade war was playing out in press briefings, a very physical conflict in the Gulf was sending the energy markets into violent convulsions.
Yeah, let's talk about the incredible intraday swings in Brent crude today. It opened the session surging past $100 a barrel, hitting 100.43.
Only to completely collapse.
Exactly. Yeah. It collapsed to an hourly low of 91.44 before roaring all the way back to close at 98.31. I mean, when I first look at headlines about military strikes and, the U.S. mistakenly hitting an LPG tanker, my reflex is to view this like a hurricane hitting an oil rig. It feels like this unpredictable, chaotic shock.
It is really tempting to view it as a random natural disaster, but I have to challenge that reflex.
Really? How so?
Because the price action tells a totally different story. If you look at the timing of that sudden drop to $91, it wasn't panic. What we're watching is geopolitical escalation as game theory brinkmanship.
Ah, right, because the market was dynamically repricing the odds of a diplomatic off-ramp.
Exactly. Friday afternoon, Trump met with his cabinet and explicitly stated that he believes Iran is, quote, getting more serious in talks.
Right. The volatility wasn't just blind panic. It was the market calculating the odds of a truce versus an outright blockade. So how did markets absorb all this?
While U.S. equities remained highly defensive, tech-heavy indices just drifted downward.
And the anchor dragging them down was the bond market, with the 10-year Treasury yield stubbornly holding its ground at 4.679%.
So, to summarize, the U.S. session was completely dominated by protective posturing against tariffs and energy shocks. Let's signal a short break before we get into the major corporate news.
Session 3, corporate events recap and what to watch next.
Friday afternoon, we got a report that Qualcomm is imposing double-digit price increases on its customers starting September 1st.
And they are citing rising component costs, right? Why should you care about this? Well, this directly hits margins for consumer electronics and smartphone makers.
It is textbook supply chain inflation making its way downstream. And speaking of massive costs, Verizon reported their Q2 earnings before the U.S. Open today.
The big headline there was a newly announced $1 billion data center deal with Google.
Yeah, it shows telecom officially entering the AI physical infrastructure space.
With revenues expected by 2027. But playing the AI landlord requires an astonishing amount of upfront capital. Which brings us to Intel's Thursday afternoon earnings report.
Right, where they announced massive capital spending increases for 2026 and 2027, mostly for equipment.
So if you connect Intel, Alphabet, and Verizon, it really highlights the broader theme of AI CapEx as a self-defeating valuation loop.
Yeah, capital flows freely to build infrastructure, but investors are increasingly anxious about near-term free cash flow.
Well, folks, as we ring the closing bell on a chaotic week, at least we can find comfort in knowing that next-generation tech remains highly affordable. Just kidding. Qualcomm is raising prices by double digits. Between trade wars with Europe and Trump threatening Canada over smoke, it feels like everything is getting a price hike. The only thing safe from a Section 301 levy is our sense of humor. If your portfolio is in the red today, just tell yourself it's a strategic supply chain adjustment.
We might all need a strategic adjustment. Let's look at what to watch next. Sunday at 6 p.m. Eastern Time, CME futures reopen.
You want to watch for weekend, Hormuz, and Red Sea developments affecting crude and safe haven assets.
Then on Monday at 8:30 a.m. Eastern Time, we get the U.S. Advanced Durable Goods Orders,
which is a key read on manufacturing CapEx.
Monday at 10:30 a.m. ET is the Dallas Fed Manufacturing Survey.
And finally, Monday at 1 p.m. Eastern Time, the U.S. Treasury will hold 2-year and 5-year auctions,
testing that intermediate rate demand.
Before we move on, I want to leave you with a deep question to mull over. If massive AI capital expenditure cycles and global tariff walls are both becoming permanent fixtures of the global economy, are we witnessing the end of deflationary consumer technology?
That is something to think about over the weekend.